lot to do with the duration of this cycle. And I think that's the mistake some people make, is they assume just because this has gone on for about 8.5 years, close to 9 if you're talking about the stock market, that therefore it's sort of doomed to failure soon. And it's not because of that. I think, expansions, whether they're economic expansions or bull market expansions, don't ever die purely of old age. They die because of excess. And I don't think we're at that point of excess, either in sentiment terms for the market or economic terms for the overall economic cycle, but you're starting to see some characteristics of late cycle. Certainly the Fed is tightening policy. We've seen the flattening in the yield curve. We're moving toward that boosted productivity, increasing capital spending part of the cycle. Inflation is starting to tick up. So we're starting to check off some of the boxes that suggest we're getting into that late cycle, but not many of them are yet suggesting that we're at the peak in the cycle. So attitudinal measures would be a lot of the well-known surveys of investor opinion. So probably the most popular is American Association of Individual Investors. On a weekly basis, they poll their thousands of members and basically ask a simple question: are you bullish or are you bearish? Investors Intelligence, which is advisor sentiment through newsletter writers. So that's an attitudinal measure. It's advisors that write newsletters, putting their opinion out there. So those would be attitudinal measures of investor sentiment, just asking through a survey people's opinions about the market. Then there's the behavioral side. It would be things like the put-call ratio that tracks what investors are doing in the options market. Fund flows, which you mentioned, actually track the behavior of investors, what they're doing with their money. When both of those show an extreme in optimism, i.e. you're seeing it in the surveys, but you're also seeing it in the action on the part of investors, at extremes, that's more of a warning sign for the market. So the point that I made yesterday was we're seeing that excess optimism in the attitudinal measures, but it's not, at least yet, being matched by the behavior of investors. Looking at even including ETF flows, mutual fund flows, but staying concentrated in the domestic equity market, we haven't seen net new inflows since prior to 2007. And that's an extraordinary thing to have occurred in a nearly 9-year bull market. And I think sort of supports this notion that there's still a bit of that wall of worry out there.